especially on the FKLI market. So probably, if you have been trading the market, you have probably seen the news. Last 2 weeks, or in fact the last couple of months, has been quite a volatile month. In fact, this year itself, 2022, seems to be starting a rocky start. But nevertheless, in the futures market, regardless any direction of the market, it's always an opportunity that's always present. So as a trader, if you are trading the market, we need to be on the lookout for any opportunities that's available in the market, and we should trade on those opportunities. So just before I start, just to reiterate what's the risk disclaimer just mentioned by Oliver, just like to reiterate again. I think dabbling in futures market does involve risk, and you really need to consult a licensed representative. So any materials here presented here today is purely for educational purpose as well. And always be on a safeguard and be on the lookout, especially when it comes to futures trading. More information, more knowledge gathering is much needed, especially when you are new to the journey. So this is the usual risk disclaimer, and there'll be no recommendations and whatnot. Just treat it as a more of an educational purpose. Now, I think in today's webinar, since we're talking about FKLI, I think it's important for us to establish, what is the outlook, pretty much in global, because Malaysia market as its own, it also does being affected by the global scenario, not only domestic play, but the global landscape does paint a picture to our performance as well. So it's important for us to establish the view, what is the global outlook is going to look like this year. So that's what we're going to do first. I'll also be discussing some of the various factors, especially when it comes to, when I mention factors, these are all fundamental factors that actually affect the indices. So if you are well familiar with FKLI, it tallies very well with crude oil performance. It also tallies well with to a certain extent the Dow Jones market, which is the external market. But of course, obviously, there's always certain aspect of domestic factors that actually can influence the indices market, which we're going to look at later part. Now, everyone is well familiar with the FKLI contract. Just last year, the Bursa Malaysia has actually launched a new contract called the FM70. That's also based on the mid-cap counters. So I think this provides a very good avenue for you to get a bit more bigger exposure in the Malaysia market scene, because the FKLI market is only restricted to the top 30 counters that's listed on the exchange. So if you want a wider spread, encompassing more companies, then the FM70 should be a futures contract that's worth looking at. Last but not least, I think towards this end part of the webinar, I'll be mainly touching on some of the key technicals, indicators that you can use pretty much to navigate the FKLI market. Probably we're using moving averages and talking a little bit on the Heiken-Ashi candles, which I've been a very good advocate for Heiken-Ashi for a very long time. If you've been following me in my webinar, because I've been using Heiken-Ashi for a pretty long time, and I think the robustness of that technical parameters is good enough for you to make a decent entry and exit positions. Now, to give you a very brief overview of the market, so I think clearly you can see, commodities is definitely the theme this year. Just late last year, everyone was saying, are we in a super cycle in terms of commodity? It looks like we are in one. If you just look at grains, energy prices, they are all through the roof. So nevertheless to say, I think this year is really a commodity play. In fact, if you look at asset classes performance, equities are not faring that well, especially with China. China now is the major underperformer in the market. I think with some of the equity bench, some of the major benchmark in China falling close to 30% year to date. That's pretty massive. Now, falling to that, I think you look at some of the US major benchmark; those are also falling close to 10%. So in fact, I think equities is pretty much out of the question this year in terms of their performance. Obviously, they are riding a very good wave the last 1.5 years after the post during the COVID pandemic season. But I think thereafter we start to see lackluster performance thereafter. So I think really, going forward, if you look at it, countries that are exporting commodities or energy play, I think those are the countries that can be quite resilient. And as a matter of fact, I think Malaysia, to a certain extent, is stands to gain, especially in the environment where you start to see a lot of commodity prices are actually going higher. You just not only looking at crude oil, Malaysia also benefits on higher palm oil prices as well. So really, I think this year is a theme of commodities. But with that, having said that, given that we are seeing rising commodity prices, it also comes with a problem. And the major problem that we all witness, not only in the local scene, but also as the international and global market, is inflation. I think inflation is the key theme that we're going to see it for a period of time. It's not going to go away. Imagine just last year, many people say, oh, inflation is probably going to be temporary, but we are way more ahead than a year plus. Inflation doesn't seem to be just temporary. It looks like to be a bit more permanent feature for quite some time. Now, if you drill in a little bit on commodity classes, obviously oil is the top gainer. To a certain extent, gold and whatnot. These are the major commodity asset classes that actually enjoy, the year-to-date gains. But the really energy segment was really the performer. You look at WTI, you have surpassed $100 per barrel, including Brent as well. Natural gas, we are definitely seeing a lot of tensions. Now, even like your grains or your soft commodities, your sugar and your coffee, be prepared to pay higher costs for your Starbucks because coffee prices are actually, going skyrocketing prices. Sugar is also almost at 6-7 years high. So it goes to tell you there's one theme that we have to be very careful of is inflation, and it's going to be a concern, because it's going to have a effect across a lot of major asset classes because eventually you're tied to what the central bank will do. With inflation so persistent, they have to do something. And later on, I'm going to just go ahead and share with you what FOMC meeting was about. But it goes to tell you that really, I think inflation is something that we have to be careful of. And if you are trading the markets, we really have to be very sensitive to the news flow that's coming from the central banks. Yeah. So I think the reason I say inflation is a key theme, we just look at it, look at food prices. It's actually eventually at record highs. So I think that's a bit of concern. The problem is that it's not only food prices. You look at your vegetable oil prices. This includes CPO as well. Vegetable oils are almost at decades high as well. So this points you to one direction, that we are going to be facing higher prices. Inflation is going to be longer than expected. So as a result, central banks around the world have to quickly make up their measures, by hiking their interest rates in a way to control inflation. If not, we probably might witness uncontrollable inflation. Now, there's a lot of reasons to why prices of commodities has been rising. A few key factors will be, we have seen supply issues, which is also very persistent. The Ukraine-Russia war has also, compounded to that supply issue. Keeping in mind Ukraine and Russia, both of these countries are also commodity exporting countries. So in a way that it will definitely affect commodities prices in general. So I think all in all, I think inflation is something that we have to be mindful of. And as if you are trading the market, we really need to be sensitive to what the inflation level is going to be. If you just look at some of the reports, a lot of people are saying that probably second half we should see inflation levels starts to moderate, because I think that's where supply will return and demand will probably be rationed. But that's again much to be seen. But the speed of increase and the big spike is definitely a cause of concern in the near term. Now this is an interesting chart. What I have here is basically to show you the Fed target rate or Fed rate against the US headline CPI number. Now the funny thing is that if you just look at inflation as a economic concern, it's not only very prevalent now. If you just look at back in 1980s, we also see a runoff inflation. I think in US at the time the inflation level was almost close to 15 to 16% on headline. That was pretty drastic. And you know what the Fed chair did that time? It actually increased or hiked interest rate tremendously and massively. And that helps to bring down and tame the inflation level. In fact, I think it took about 3 years, from where 16% on headline CPI went all the way down to about 2%, which is their long-term target. So in a way, I think policy tools like hiking interest rate is a very important tool that the central bank can use to actually control inflation. So in other words, right now, I think we just passed FOMC back in March, just a couple of days ago. The stand is very clear. They are starting to hike interest rates. The question is the quantum. So on every meeting going forward, it's not a matter of whether they hike or will not hike. It's a matter of question is how much are they going to hike? Are they going to hike 25 basis point, or are they going to hike even more, 50 basis point or whatnot? So if just look at it, the CPI rate number against the Fed target rate is still pretty much a big gap to fulfill. So really it's talking about the pace of how the Fed wants to tighten and how aggressive they're going to be. So we want to watch out because every FOMC meeting going forward is going to be quite volatile. Market is going to be very jittery. So that's where, whether you are trading on the external market or even the local Bursa Malaysia, we really need to be aware what's going on, especially when it comes to Federal Reserve meetings. Now, so this is what happened in 1980s. Are we going to, learn? If history is served any guide, I think likely Federal Reserve is probably going to use the interest rate mechanism as a way to tame inflation. If they have done it successfully back in 1980s. Obviously, we can always argue, the environment in 1980s and right now, the economic environment is totally different. Back then we have services sectors in US is only contributing about 10% of total GDP. Right now it's almost more than 50% of the total US GDP. So again, environment could be different. But if history serves any guide, it looks like there's only one way that the Federal Reserve can control inflation is to hike the interest rate. And it's a matter of how aggressive they're going to go. Now, obviously, with inflation being so being a press of concern and being so persistent, the next question that always people ask is that, are we going to be going to a period where inflation starts to knock us off? And this is what we term as stagflation. We have a stagnant economy doing an inflationary environment. Now, the risk is highly probable, given the fact that if you just look at some of the key indicators, like look at your yields on US Treasuries, those yields are indicating that economy is probably going to be worse off going forward instead of better. Despite interest rate going up, we should see demand starts to pick up, but that's not the case. So I think that's probably could be a sign of concern. I think really market is telling you that this interest rate is very imminent. There's no other alternative that the Fed can do. But what is important is that they are always believing that the US economy is on a strong footing. But if any sign that any indicators that point you on the downside, I think that's where we need to be very careful. So we can't really discount the risk of stagflation at the moment, but in fact the probability has increased because just judging by some of the markets we are seeing, some of the indicators you are looking at as well, I think those are showing you sign of weakness, and that's where we should pay a bit more attention going forward. Obviously, this is going to be a concern because every time when US hike interest rates during a bad economic situation, normally the economy will fall into stagflation, and that's where generally the market will be very concerned of, and we should see a lot of risk off in the market. Now, this just to show you the supply chain issue. So you can clearly see there's a lot of hike up during the COVID season. But then after that, we saw the effect start to taper off second half of last year. But then again, it returned. Now, we saw a spike increase in supply chain pressure recently because the Ukraine-Russia conflict is actually aggravated the supply chain again. But looks like we might near the peak. So going forward, I think given a couple of weeks later, we should see supply chain pressure start to ease. And that's where economy starts to recover again. If you just look at Baltic Dry Index, which is a measurement of shipment fees and costs, we have came off high, and looks like things are going to be quite normalized in the next couple of months. So I think currently we are facing quite a supply squeeze, but going forward we should see this pressure to be eased off, and that's also a good news. If it comes to commodities, we should start to see prices start to taper off towards the second half of this year. Now, I'm not going to reiterate some of the key US data. I think a lot of news are also pointing the US economy is actually on a strong footing. Employment numbers are, you look at it, they're all fairly good and okay. What I want to highlight is that if you just look at projections by the recent FOMC meeting, they are actually quite optimistic on their own economy. They are looking at lower unemployment rate. And the funny thing is that by 2023, FOMC is projecting that inflation should return back to normal. These are all projections. Projections are all based on estimates. They are all based on models, and models usually can be wrong. So what I want to highlight here is that based on my view, I felt that the projections are quite optimistic. Inflation to take probably a half a year to bring it down by 50%. It is quite tough. Unless the situation warrants it. We start to see prices starts to come down. I think the main key thing that what drives inflation to such a high record level is always commodity prices, and the main culprit is always energy price. So you look at it, WTI, we are above 100 now. And personally, I think anything above 100 or 130 onwards is definitely going to face a lot of demand destruction. I think really, if you want to see CPI numbers to start to come down, you really need to look at commodity prices, especially energy. If energy doesn't want to come down, unlikely CPI numbers will start to ease. So I think, take it with a pinch of salt. I think FOMC projection seems to be very optimistic in the sense that they are predicting inflation will start to normalize probably by next year. I'll find it that a bit difficult because as long as commodity prices are quite high, it's very difficult. Now, so going forward, as a trader, it's always your preference. Every trader will have a different preference whether they like volatility or they don't like volatility. So those who love volatility, they always like to trade on FOMC dates because during that time, market gyration will gyrate a lot. Obviously, when it comes to excitement, your risk parameters also have to be careful. So going forward, we still have another 6 more meetings, and that's where I think markets expecting that in each of these meetings there will definitely be a rate hike. I have to be careful to use the word definite. I still think that it's high probability that every meeting that they're having will probably be a rate hike. Question is whether it's going to be a 25 basis point or 50 basis point. It goes to show, I think, the US Federal Reserve has to ramp up, their interest rate movement because, inflation is, they are way behind the inflation curve. So that's something that we have to be mindful of. Now, it's not only FOMC, the Fed is hiking interest rates. They are also rebalancing their balance sheet, which means that there will not be any buying assets in the open market. In fact, they may be withdrawing some of the stimulus and they may be selling some of their assets in the open market. Now, if you take any precedence back in 2017 when Federal Reserve did that, when they start selling assets to the open market, the market reacted quite negatively in the first few months. We are not sure how this will happen. If just look at, we are still waiting for the minutes, but if just look at FOMC minutes, it looks like in the upcoming May meeting, they may start to sell some of the assets on their balance sheet. When that happens, that tells you they are really tightening their pockets, and that might have a repercussion in the equity space. So do watch out. In fact, I think going forward, every FOMC meeting, market may react quite in a volatile manner. So do make sure you put your risk measures on place, especially when it comes to this meeting periods. Now, I would like to assess market risk through weeks, which is a very good indicator. Market usually term this as a fear indicator. So weeks basically measures the S&P 500 index implied risk options. So you can clearly see, the levels right now are quite elevated. You are above 30, which is the long-term average is about 20, 25. So right now it tells you the market is a bit more cautious. Risk on is definitely being placed. I think this is mainly heightened due to the Ukraine-Russia conflict past couple of weeks. But what's interesting is that despite we are seeing a lot of tension in equities market, one should always think that the fear index will be quite will be spiking, but it's elevated, but it's not spiking. And if you just look at the news flow that's coming from Ukraine and Russia every day on a daily basis, it looks like the market is actually quite comfortable in a sense that they pretty much factor in what's likely to happen in the Ukraine-Russia conflict. So obviously, I think we still see risks are quite elevated, but it's not as high as compared to when we got hit by the onset COVID-19 pandemic. At those days, VIX levels was almost breaching the roof at about 80. That's really a market panic. But right now we are looking at the market is a bit jittery, but they are not panicked. So I think that's a major difference, and one should be also careful of. If you just look at what we call the VIX term structure by taking prices of VIX futures contract across a year, we can see that probably by second half of this year, after the September-October period, we start to see the risk of the market starts to taper off. Again, I think this goes to show short-term, these are all short-term views. Eventually, over the medium to longer term, market is still quite complacent in the sense that risks are still quite moderate. There's nothing much to excite the market in the medium to longer term. So again, this is where a lot of market practitioner that they like to view this. During this time, it's always good to employ the buy and dip strategy. I mean, I'm not advocating that strategy per se, but what I'm trying to tell you is that the market looks like going into the medium term. It looks like market is quite comfortable at this point in time. Now, I like to point this. I like to point this yield curve, the US yield curve in particular. So for those who are not familiar with, is that usually when yield starts to rise, normally it tells you that interest rate will start to rise. What is interesting is that if you take the short term, which is the US 2 years Treasury against the medium term or longer term Treasury, which is a 10-year, if you take that difference, normally, in a normal yield market, the longer term will always offer a better return because as you go longer in a period, there's a lot of uncertainty. So if you're an investor, you should be compensated higher. Now, if the longer term yields are lower than your shorter term yields, that should usually signal that there's a great uncertainty in the market. In fact, if you just look at for the past 40 years, every time when the yield starts to turn negative, especially when the difference between the 2 years and 10 years Treasury starts to go negative, usually it precedes into a recession period. This is historically speaking. And if you just look at the bottom chart, the shaded area, so if you just compare to the top chart, every time when you start to see yield starts to invert, normally you start to see recession in US market. So we have seen a couple instances like during the 1980s, during the late 80s, in fact early 2000, and the latest one is the GFC, the global financial crisis. So really, I think now if you just look at the difference in both this 2 years and 10 years Treasury, we are almost reaching zero par. What is concerning is that if it goes into a negative, which is inverted yield, that's where a lot of market practitioners will think that no, we are probably coming into a recession period. Whether that will hold true, I think really that really much to be seen. But some of the key economic indicators, if it's like business sentiments, are showing you, that might be the case. So do watch out on this space. Do pay close attention to. I think this is what market is also observing at this point in time, because again, this will have repercussion not only through the US market, is pretty much across the board. Okay, so coming back into Malaysia, so if you just look at Malaysia performance as a whole, if you compare the different benchmark that we have, if you compare the FBM KLCI against the small cap, against the FBM 70, and even the ACE market, I think really the KLCI has been very resilient. The top 30 counters, that's listed on the exchange or listed in the KLCI index, is showing you a very strong performance. I think year to date they are up by marginal 0.1%. But if you compare with other benchmark like small cap or even the FBM 70, the small cap index looks like to be gaining a bit more strength. The FBM 70 didn't fare that well, but the biggest underperformer is the ACE market. So really, I think this year the biggest underperformance are those ACE market. The counters and stock that's in the ACE market, they didn't really perform that well. So I think really, it goes to tell you that really companies that's been performing well with strong cash flow, with good business framework, I think those are companies that stand to gain, especially during these volatile times. Now, Malaysia is in a very sweet spot right now, for the simple fact that both our major commodity exports, the palm oil as well as crude oil, both of these prices has actually seen a very strong positive performance. So if you look at it, I think even it's indicative by the Malaysia bonds market as well. The reason being is simple, because Malaysia is still a net export commodity. So when we've seen a very strong commodity play like what we're seeing right now, normally foreign inflow will come in and they'll be buying into our stock market. So I think you can clearly see countries like Indonesia and Philippines, which is a very net importing country. The funny thing about Indonesia, although they are very large in terms of their CPO export, when it comes to energy, they are net importers. So if you look at it, they don't tend to benefit, especially when they have high energy prices. And obviously South Korea, they are net importing in terms of commodities. They are badly affected this time, especially with rising commodity prices. So really, I think Malaysia in a very sweet spot, in the sense that we are gaining both in terms of higher commodity prices, which is helping our book balances. Now, if you trading index, you notice that in recent times the volatility of the market has actually increased. So what I have here is that if you just use the average true indicator as a technical indicator to tells you how much of a daily range the market moves. Normally the market will move in a range of 10 to 14 points for the futures contract. Now, just March alone, after the breakout of the Ukraine-Russia conflict, you can clearly see that the daily range is actually expanded from, I think, almost double. So this gives you an opportunity. If you are a trader, you would definitely like a lot of volatility. You like to have markets that tend to have a big range on an intraday basis. So because if you're an intraday trader, that gives you a lot of opportunity. So I think in a sense that what I want to highlight in this chart is basically to tell you is that when markets are volatile, it's also a good opportunity for trader, and it's also a good time for trader to employ a proper risk management, because when market is volatile, true enough, we get opportunity, but it's also true enough that we may get swing off by the market if we are on the wrong footing. So without proper risk management, one can easily be shaken by the market, and that's where we need to be careful as well. Now, whenever we talk about FKLI market, we like to compare with Dow Jones, because in those days, if you look at the market probably 3 to 4 years back, you can clearly see before the COVID era, there's always a close relationship between the Dow Jones and FKLI performance. Even in fact during the COVID season as well, we start to see both these markets actually has a very close relationship. The funny thing is that the underperformance of FKLI starts to kick in, probably during the later part of 2020, and that's where Dow Jones really was on an upswing, a huge upswing. So clearly you can see there's a big, a big gap between the Dow Jones and FKLI. But what I want to highlight is that of late, we start to see there's a divergence, in a sense that whenever FKLI perform well, Dow Jones will be on the reverse. And that's a good thing, because like I mentioned, I think Malaysia as a whole, we are we always stand to gain, especially when commodity prices are good, and that's what we are seeing right now. So and Dow Jones, on the other hand, whenever energy prices tend to be strong, they tend to be a bit more sensitive to commodity prices, and they tend not to do well. So I think that's where we start to see the divergence. But all in all, there's still a bit of linkage between Dow Jones and FKLI, in a sense that they do move in parallel, and that's actually a certain period in time. It's not always the case, but it's always a good reference point if you want to roughly track where FKLI will go. Start to track Dow Jones as well. But do be careful, especially during seasons like this, where we have strong commodity price environment, which is beneficial of FKLI, but it's not that good for the Dow Jones market. Now, just tracking sentiment wise, as I mentioned earlier, the VIX index is elevated, but I'm not telling you the market is panicked. If you just follow CNN Money, they do have an indicator that also tracks markets, fear and greed indicator. So again, I think it goes to tell you generally the sentiments are still quite poor. They don't see any optimism in the market for at least the couple of weeks or even months. And you just look at this Morgan Stanley report that tells you some of the big fund managers in the US are actually going into more cash balances. They're holding more cash rather than putting into the market. There's two signals that we can get from here. First thing is that these fund managers who've been well invested in the market for the 2 years, past 2 years, has actually starting to take profit. they are going into a sideline. They are holding more cash. Is one simple reason to explain this scenario is basically, I think, as long as Federal Reserve starts to hike interest rates, the cost of holding money starts to increase, and I think fund managers are very tempted to hold more cash during a high interest rate environment. So I think that's also explains why the Dow Jones market has actually been experiencing a lot of weaknesses of late, and I think it's probably going to be foreseeable in the future as long as Federal Reserve is on a high interest rate cycle. That's what we're going to be probably seeing more going forward. So I just summarize some of the risk factors that we should be looking at. So inflation is definitely one theme. COVID-19, right now we're still in a pandemic, so there's a lot of unpredictable factors. New variant is always a concern. That's always on and off. Geopolitical tension. Now I think really the conflict in Ukraine and Russia really opened the door, in a sense that if we just hope that the bug will stop here, but if it doesn't stop here, really I think it's going to translate into the whole Europe region, and that's going to be very tense situation across the world. So I mean, really I think we do have to watch out news flow that's coming in from this conflict daily basis. I think domestic politics is something that we also be mindful of if we are trading FKLI market. Oil price volatility is something that we also have to be careful. Like I said, we are in a high price environment. Any shake-off or any break of conflict can always spur energy prices into higher levels. And Malaysia is still quite, if you look at the news flow that's coming from Malaysia market, it's still very sensitive to foreign inflows and outflows. So as long as foreign inflows continue to come in, I think Malaysia index itself is still quite supportive. But if it's seeing a lot of outflow, then it's a different story. Now, just to highlight some of the fund flow going into Malaysia. So reason explain why FKLI has been quite strong, especially during the start of the year. If you can see, there's a lot of foreign inflow coming to the Malaysia market towards the later end of January onwards. That's where you start to see FKLI start to gain some strength. So really, I think the recent performance you're seeing in the market, the strong performance you're seeing in the market, can be mainly attributed to foreign inflow coming in. And like I mentioned earlier, Malaysia is going to be a net gainer, especially when you see high commodity prices. So one way to look at it, really you want to watch the performance of FKLI. Do pay attention to foreign inflows and outflows, because ultimately this will have an impact on your FKLI performance as well. Now, if you talk about foreign fund flow, you have seen, for the past decade or so, we have seen actually a net outflow for many years. Now it looks like we have quite reached a stable point, quite bottom out. In fact, I think last couple of weeks or so, we have started to see foreign inflow coming in. But whether that will just be a temporary feature, I think that's very much to be seen. But really, I think Malaysia benchmark performance is still very much dependent on the foreign inflow and outflow. So I think this is one parameter that we really need to pay close attention to, especially when you want to track the FKLI performance. Now, the reason I want to point out this slide is because, although I keep mentioning that Malaysia is always a net gainer, especially when you have high commodity prices, keeping that in mind, although we have high energy price, we should benefit, but whatever prices we pay on the pump is also subsidized by the government. So if you just look at RON 97, which is floated on the market, but RON 95 is subsidized by the government. So every $1 US dollar increase on the per barrel basis, government is actually subsidizing about close to 400 million ringgit, and that's a lot. So this goes to tell you, even though we are enjoying, we should be enjoying the high energy price, but keeping in mind, we also need to support the domestic economy by subsidizing petrol, especially for the RON 95 and diesel. So really, if you look at the net result, we might not stand to benefit that much because we are still subsidizing for RON 95. I think that's something that we really need to be careful of. So I think government is finding it very difficult. If crude oil continue to climb, really I think fuel subsidies budget is going to continue to climb, and eventually whatever we gain on the sales of petrol will probably be offset by the higher subsidies that the government is paying. So I think that's something that we need to take note of as well. Now, this is just a very brief overview on crude oil. I'm not going to touch too much on the fundamentals of crude oil and whatnot. But again, I like to emphasize is that, you know, we probably the last couple of days we see a bit of retracement in the crude oil environment. But do watch out. I think, you know, the crude oil price will likely be sustained and likely to go even higher. The point that really the market should be paying close attention to is to revisit the high point at 130 US dollar. I pretty much believe that any point, because if you look at 2014, back then when crude oil did touch 130 US dollar, it didn't touch there for long, because that's where demand starts to see a lot of tapering. That's where you see destruction in demand. So likely you're probably going to see those levels again, but unlikely it's going to sustain over there. But as long as markets continue to hold above 100 US dollar, be prepared that your inflation level is going to be quite stubborn. So I think that's something for us to be taken care, especially when it comes to in relation to inflation level. So I'm just showing you FKLI is actually moving quite in tandem in crude oil. You know, again, I think the play is whenever you have high oil price environment, Malaysia will stand to benefit. So there's a lot of foreign inflow coming in and to support the market. So yep, I think really the key level to watch out is 130 US dollar. Anything that's above that, you start to see demand starts to taper off. Because I think, you know, 130 US dollar, a lot of countries will feel the brunt of it. That's including Malaysia, because again, you know, we do subsidize for some of the key fuels market at around 95, which is going to be a big pocket for the government. Now, besides crude oil, look at if you compare CPO prices and FKLI, you also tend to move quite in tandem. Again, I think, you know, Malaysia is a key CPO exporting country. So whenever you have high CPO prices, normally it tend to be beneficial for the market. Now I'm not going to go too deep on CPO fundamentals itself, but I want to highlight is that, you know, as long as Ukraine and Russia issue and war is still ongoing, it's unlikely for, you know, CPO prices to come down. In fact, I think it's going to probably stay within a very tight range going forward. Now, obviously, going above 6,000 and 7,000 ringgit per ton is actually quite difficult, because it's definitely going to trigger a lot of demand shifting over to the next best alternative, which is soybean oil. And again, I think that's also one of the equations that we need to take care of as well. Now, the reason I show this is because I think the Ukraine and Russia conflict is trying to aggravate the commodity price even further. Reason being is because if you look at Russia, is also a major exporting country for fertilizer. Now, if you hear some of the grievances by some of the plantation companies, is that, you know, fertilizer costs is going up the roof. So if eventually, I think we as a consumer of a commodity, you definitely feel the impact. So really, I think this is going to be a cause of concern. And I think as long as the tension is still on rising, that's going to be something that's going to keep commodity prices on the high side. Now, to show you the Ringgit and FKLI relationship. So I think generally, whenever you have a stronger Ringgit, I think market will tend not to be that supportive. But when you have a weaker Ringgit, although it goes on the contrary on the general opinion, but normally when you have a weaker Ringgit, it's quite supportive for the market. So I think generally, you know, as an external investor, normally they prefer a weaker Ringgit compared to a stronger Ringgit. So okay, so I think that's pretty much covered on some of the key factors that one should watch out, especially when you are looking into the FKL market, and some of the key trends that's actually happening in the market. I think next I'm going to share you on a technical aspect. I think one thing is that as a trader, whichever market you are trading with, is always to make sure that what trend of the market that you are in. If you're a trend trader, normally you want to wait for a market to show you that the trend of the market is clearly on an uptrend or a downtrend. So one good way for you to identify a market is to use some moving averages. Obviously, you can depict the trend of the market by just looking at it visually, but to aid you to to get a better clarity, you can always use a exponential moving average. And if you just use a 200 days, that will be quite sufficient. So in this regards, if you just look at it, the 200 moving average is actually going quite on a flat line. That tells you that actually the market is still quite in a range. Obviously, we saw the downtrend market happening during the COVID. There's a couple of instances whereby the market tried to go above the 200 period EMA, but it didn't quite sustain there. In fact, towards the second half of last year, we start to see market weakness. But I would say the market is very well supported around the 1,500 key index level. I think that will still continue to support the market. So right now, I think the market is still on a side range market. So during a sideways market, normally you will employ a sideways trading strategy, and you won't be using any trend trading strategy. So the first thing you need to do is always to identify what is the overall trend in the market. Are you in an uptrend or a downtrend market or in a sideways market? Because that usually will help you to identify what type of strategy that you can use for those types of market. Now, like I mentioned, I think we are in a sideways market for quite a long time. In fact, we are in quite a tight range between the 1,650, in fact, 1,700 to 1,500, 200 index points for quite a pretty long time. So, if you believe that this range is going to sustain, normally, every time when it comes to the support region around 1,005, you should be taking a long position. And anything that trying to reach above the 1,700 resistance point, that's where you should be looking to short the position. So as long as this market is moving on a sideways, it doesn't show you there's a strong uptrend or downtrend. It's still pretty safe to base on your key decision entries on the support and resistance level. So besides looking whether the market is trendy, you can always use an indicator called ADX indicator. So normally this will tell you whether the reading of the market, the market is trending or not trending. Whenever you have high ADX value, let's say a value above 35 or even 40, that tells you the market normally is going to trend. And whether it's going to trend upwards or downwards, it tells you the market is trending. And during that time, it's good for you to employ trending strategy. And when ADX value falls below 20 or even below 25, normally that tells you the market is actually on a side range market. So right now, you probably can see, the value is probably about 25 to 20. So that means the market is actually quite side range for this period of time. So it's good that during this period of time, you can actually employ some sideways trading strategies. That's quite beneficial for you to capture some of the quick momentum that you can see in the market. Now, after you identify the trend, it's also good for you to put your timing. How do you time your entry and exit? In the earlier part of the webinar, I did mention that I'll be just mainly talking on candlesticks. Now, I like to use Heiken Ashi, which is the derivation of the Japanese candlesticks. It's slightly different than the normal Japanese candlesticks in a way that if you use Japanese candlesticks, you need to memorize a lot of figures and configuration. There's thousands of configurations in the Japanese candlesticks. It can get very confusing. Heiken Ashi, there's only 3 simple patterns. It's just also color coded. So every time you see a green bar, normally that tells you the market is going to trend higher. Red bars tells you the market is on a downtrend. So in a way, Heiken actually gives you the clarity of the trend in a better way compared to Japanese candlesticks. The drawback obviously is, candlesticks, you can see the gap. Heiken Ashi, if you use a Heiken Ashi candles, you can't see the gap. So in a way, I think that's a drawback. But if you are quite well familiar and you're comfortable with it, I think Heiken Ashi, when it comes to really looking into the strength of the trend and where the trend is heading, I think Heiken Ashi is a better choice. Now, besides using Heiken Ashi, another way to reinforce your entry and exit position, you can also obviously overlap using exponential moving average, which is one of trading strategy which I always uses. You can always incorporate 2 double line exponential moving average. One's a shorter period, one's a longer period. The shorter period is the 9 period EMA. The longer period is a 20 period EMA. So whenever the shorter term crosses above, that tells you market is going to go higher. If it crosses below, market is going to go lower. And you couple that with the Heiken Ashi candles, which tells you that we got green candles, and the shorter term is crossing above. That usually be a good point for you to enter the market. Vice versa, if the shorter terms is crossing below and you see a red candle, normally that tells you that generally the market is going on a downtrend. It's also a very good entry for you to be in the market. So these are some classic examples of using Heiken Nashi together with moving averages to time your entry and exit. So what I have here is that you have a shorter term crossing, start to cross above the 20 period EMA, which is a longer dated period, and you start to see green candles in the Heiken Nashi. That tells you generally the market is going to go on an uptrend, and normally that will be the position for you to enter. You can hold that position until whenever the particular candle crosses below or the breakout of the moving averages. So if you can clearly see, whenever the color coded Heiken Nashi start to change color from green to red, that tells you the trend has changed, and that usually be the point where you start to exit. Or even in fact, if you combine, you can put a bearish crossovers whereby a shorter term crossing below. That also be a good point for you to be exiting the market or exiting your current positions. So last but not least, I think that's once you identify a trend, you identify how you're going to enter and exit. Importantly, in every market, in every situation, especially right now, whenever you see the volatility of market starts to increase, evident by the ATR showing you a daily range of more than double compared to last couple of months, it's important for you to always employ a risk management tool. I think one good tool that you can use is what we call average true range. It's an indicator that's available on most of the charting platform. So ATR basically tells you what is the daily range of the high and low. So say for example, if the ATR value for today is 9 points, and you start to see there's a short entry signal for you to enter the market. And if you work on a 2-to-1 reward to risk ratio, okay, so basically you take a short position at 1580, and your target profit will be 2 times of your risk, which is 18 points. So you put a target profit key level at 1562, and you're only willing to risk 2-to-1 ratio. That means you're only willing to risk 9 points. So you should put a stop loss at 1589. So that's how you use ATR to position your risk management that follows the market dynamics. So as long as market gets volatile, your stop loss level will also be higher. But as long as market starts to narrow down the volatility, your stop loss level will also eventually be narrower. So that's how you use ATR, which is quite flexible and dynamic according to the market situation. Now, I think this one concept which I want to share is basically comparing the futures FKLI contract against the cash contract, which is we call it a KLCI index points performance. Obviously, the FKLI futures contract underlines the KLCI, and in theoretical perspective, it's supposed to trade, should be moving in tandem, and there shouldn't be any big difference between both the markets, because eventually both are in quite a similar market. Now the funny thing is that there's always point in time where these two markets doesn't move in parallel, and in fact there's always gap in between, and that's what we always call it a basis point. And if you monitor the basis point itself over the past couple of weeks, we notice the difference starts to get wider. Normally this happens is that when there's a lot of risk sentiment in the market, and just off late you start to notice that KLCI performs much better compared to the futures contract, and right now I think the basis is about 10 points, which is quite huge. Normally there's a bit of underperformance, but between the range of 4 to 5 points, 10 points is actually quite big. So what it goes to show you is that I think in the futures market, a lot of people are also taking short position, whether it's to hedge their portfolio or whether it's just to take a view. But going forward, it looks like the KLCI performance can be quite a drag. So eventually the basis will start to narrow, but it's just a matter of time. But it gives you a bit of sentiment feel of the market to show you how the general sentiment or general participation in the market feels about the market. And I think generally, they felt that the futures performance will start to going forward, the KLCI performance will start to taper off. I think this is mainly because of the risk off we are seeing in across the markets recently, and I think that's is highlighted by the future basis here. So I think this is just to give you a very brief concept on how you can look at a basis as a way to judge how the sentiment of the market is going forward. So I think this is a few last bit on my slide. I'm just going to share with you the seasonality of FKLI. I think over the past, over the past 14 years, FKLI monthly performance, I think December has been a very strong month. So the December effect for FKLI is actually very strong. So if you want to trade the market on the upside, just avoid all other months and just trade on the month of December. Is this based on historical data? Again, I think this is assuming historical value will give you a bit of future value. That's the assumption that we need to have here. But if just look at historically speaking, I think December is actually a very strong month. And generally, I think if you look at it, middle of the year, FKLI may not perform that well. And usually around August, September, usually these two we consider quite a bad performance months, including May as well. So again, I think this seasonality does help you paint a picture in terms of where you can see yourself, especially when going into particular month where you think that this is going to be a weak month in terms of historical performance, and that's where you tend to have a bit more biasness in that sense. So I think that's helped you to generate a view of the market based on historical performance of FKLI. So I think the last bit here is basically to compare FKLI performance and FBM 70. And generally they move in line because ultimately FBM 70 is just a derivation of FKLI but include some of the mid-cap counters. But the funny thing is that the underperformance of FBM 70 compared to FKLI is quite prominent of late. It goes to show you, some of the blue chip companies in Malaysia are actually quite resilient. So this is basically the FBM 70 futures contract specification. So like I said, I think last year they just launched, Bursa Malaysia just launched this new contract to cater to the audience, to allow a wider spread of companies to be covered under the futures contract. So in a sense that it gives opportunity for traders who wants to hedge their portfolio, which not only consists of the blue chip companies. You're only looking for some of the mid cap companies. You can obviously get a contract that fits those criteria. And again, I think the contract size is also quite fairly okay, and it's quite fairly good for you to trade as well. So take the opportunity to try to look into this contract. It has the similar characteristics to the FKLI performance as well. So coming to the end, I think regardless whether how we are doing and what the global market is going to go through, we have to acknowledge the fact that we are going through a period of higher volatility. That's a given fact. How are we going to navigate this period? Really, I think if you are trading the market, you have to watch your positions very closely. Like I mentioned earlier, the risk management is paramount. I think that's key. If you approach your trade without proper risk management, really, I think during this time, it's going to be a very tough time for you. Now, I think global risk is very imminent. Geopolitical tension is going to be something that is going to be talked about. Inflation is also something we're going to be talked about. I think these are the two major themes probably going to bring us towards the whole of this year. And I think last but not least, risk management is always key. Whether you are using it as your trading or whether you are planning to use futures as a way to hedge your risk in your stock portfolio, I think that's also a very good tool. I think futures does provide you that kind of avenue. But nevertheless, I think given that this kind of environment that we're in, it's always good to measure your risk accordingly. That's where risk management is always an important strategy when it comes to trading ultimately. Okay, so I think that's pretty much the end of my presentation. I'm just going to hand it over to Oliver right now for any Q&A from the audience.
Okay, thank you, David, for the great presentation. Okay, just let me show the screen. Okay, so now is our Q&A section. So guys, if you have any question for David, you can just leave it down at the Q&A at the comment box there. Okay, so while you guys are actually writing, so just let me continue with my part. Okay, so if you're interested in trading FKLI but you haven't have account with us, you can actually open an account through online with us. So we can actually just scan the QR code, and our platform is free, and we actually do provide a wide range of product for you to trade as well. Okay, so we actually also have an awesome reward, which is also in conjunction with this webinar. So you actually can trade for FKLI, FCPO, FN70 and FEPO to actually earn the cash reward up to 400 ringgit. And if you open an account with us, you can actually get a chance to win a Food Panda voucher as well. So do scan this QR code if you are interested. Okay, so our Q&A section will be after, for our Food Panda voucher. This lucky draw section will be after the Q&A section. The Q&A. Okay, so let's see. Is there any question from the floor? Okay, give me a second. Okay, we actually have from Sam. He actually realized that FKLI have got a sharp drop during the last trading hour, and comparing to the KLCI, which is going up, why is there a big divergence there?
Yeah, that's a very good question. It shows that this guy is actually trading the market. If you notice the market last 2 days, the basis is actually quite narrow. It's normally for the past 2 weeks, the basis between the cash and the futures market was trading about 15 points. Just last 2 days, it's actually narrowed down to about 4 to 5 points. But the funny thing is that towards the day end, the spread widened back to 10 points or even more than 10 points. Now, why this happened? There's a couple of reasons. I think firstly is because as we go towards the weekend, a lot of futures traders, or whether they are trading the market, they don't like to hold whenever going into the weekend, especially during time like this. Any news over the weekend, whether it's the development on the Ukraine-Russia conflict, it will have a big impact coming on Monday. So that's where I think generally, they tend to be a bit more risk off. They tend to sell more or get out of their position in the futures market toward the end of Friday. So I think that likely explain why there's a big divergence between the cash market and the futures market towards the closing, especially for today.
Thank you, David. Yeah, so let's move on to the second question. So we have another question from Sam. Is what would be a good trading? What will be a good daily trading strategy for FKLI?
Oh, what is a good trading strategy for FKLI?
Yeah,
well,
daily.
I think daily, right? Yeah. So if you are looking at intraday trading, I think you can use the strategy I mentioned earlier, using the EMA and the Heiken-Ashi crossovers. Keeping in mind the time frame I'm using is 1 hour. I think 1 hour for intraday it is sufficient for now, because you look at the volatility is actually increased. You easily talking about 19 points in on single day. I think today alone you are looking at about close to 20 points. So I think on an hour basis, using the EMA crossovers, using the Heiken-Ashi is quite sufficient for you to use it as a basic intraday trading strategy. I think that's helpful enough.
Okay. Yeah. We have another question here from Brian. So, FKL for short term or long term, how to strategize both type of trading?
Okay. That's also a very good question. FKLI short term, I'm okay. I'm assuming the question here referring short term and long term as to time frame. And that's how I'm going to approach this question. So because again, I think this is it depends on perspective of the trader. If that person is naturally real short term as nothing more than a couple of days, and long term nothing more than a couple of months, that's totally different from how a trader will view short term and long term. But I will give you from the perspective of myself as someone that's trading the market on a daily basis. So short term to me, I think we are talking about on daily basis, or even sometimes up to an hourly basis. Longer term will probably be more than a couple of days or even weeks, nothing more than a month. So obviously the strategy used in both this time frame is different. Shorter term, normally you use your EMAs, probably you use a shorter parameter. Longer term, probably use a longer term EMA. So just now I give you an example, 9 days, 9 period against 20 period. So you are using longer term, probably you need to look at 50 period EMA. Then Heiken-Ashi, you probably need to use comparing candlesticks and Heiken-Ashi for the longer term basis, because I noticed that if you use Japanese candlesticks on a longer term framework, it works better. But on a shorter term time frame, Heiken-Ashi works better. So that's how the difference I will use if you look at in terms of difference of time frame regards to strategy.
Okay, yeah, we have another question here is that what is the time delay for using Phillip platform? Is it free? I think I will answer for that question. So for us, our platform, we actually using Phillip Nova. It is actually free. So our live account, we actually do not have any delay lah. But if you're using our demo, you may experience a delay of 15 minutes. Okay, so we'll be taking the last question here. So the last question from can we get from Howard Gunn? So Howard he said that for FKI consider fast trader or long investor which better? I think he means that is it FKI is it suitable for a more short term or long term? What's your opinion, David?
Yeah. Now again, I think this is a matter of perspective. I think really thank you for the question. I think really if you it's a matter of perspective. If you talk about someone, I mean I'm giving you the viewpoint of a trader. So obviously my objective whenever I go into any of the markets is to make a quick buck. So whether it's considered fast, I'm not on the business on a long term. Long term, normally you talk about investors and whatnot. You see, the futures market itself is just a tool. It all depends on how you're going to use it at the end of the day. So myself, I'm more to a trader, which you're going to be in and out of market every single basis. So really, I think to me, I need FKLI to be on a you'll be using FKLI on a quick or fast manner. But if you use, for example, you can always use futures market if you have a long-term view. I think one of the key drawbacks is that holding a futures contract do have an expiry, but that's where you can always roll over your contract, or you can even position. Let's say you want to have a view that is 6 months later. You can futures market is close to a year, so you can always position your view based on the futures market as well, and that's also in a way longer term perspective. So I think it caters for both types, whether you are considered yourself a fast trader or whether you're a longer term investors. Futures market does cater for both, and it's a matter of tool, and it depends on how you're going to use it.
Okay, thank you, David. Okay, so we actually still have some question here, but I think we will just reply you guys after this webinar, maybe next week lah, on the next business day. Okay, so let's move on to our lucky draw section. So a quick reminder here, we're actually giving out 20 Ringgit e-voucher for Panda. So you'll be using 3 questions. So answer it correctly, you have a chance to actually win this Panda voucher. So we'll actually be using a poll, and then guys can just click it later lah. So I will be giving you around 10 seconds after I read out the question. Okay, so are you guys ready? Okay, so first off, the first question is what product does Awesome Trading Reward offer? So first one, you have the FKLI, FN70, FCPO, and FEPO. B, is it a crude oil and gold? C, is it soybean oil, soybean and corn? D, is it Dow Jones, Nasdaq, S&P 500, and Russell? Okay, just let me pull out the poll. Okay. Yeah, guys, you can actually pick it up. Okay, 6, 7, 8, 9, 10. Okay, I'm closing it. Okay. Okay, so thank you for the response. Let's move on to the next question here. So, okay, what is FN70 value per tick? So is it A, 5 index points for 10 ringgit, or 5 index points for 20 ringgit, or is it 30, or D, is it 40? Okay, hold on, just let me get a poll. Okay, so guys, you can actually fill out a board. Okay, 7, 8, 9, 10. Okay, I'm closing it. Okay, the last question may be a bit harder, so I think I'll give you guys some more time for it. So maybe you guys can actually think through it. So are you guys ready? Okay, the last one will be okay, what does inverted yield curve mean? Okay, so here you can actually select the best answer. So is it A, short-term interest rate fall and long-term interest rate rise? B, is it short-term interest rate rise and long-term interest rate rise as well? Or C, short-term interest rate fall and a long-term interest rate fall. So D, short-term interest rate rise while the long-term interest rate fall. Okay, so just let me pull up the poll. Okay, guys, you can actually get the answer here. Okay, so if you guys maybe around 15 seconds, so maybe 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, guys, can respond. You may have a chance. Yeah, okay, I'm closing it. Yeah. Okay, so that will be all for our Food Panda voucher giveaway. So do stay tuned. We will actually email you to notify you whether you actually are the lucky draw for the 3 Food Panda voucher lah. So check your email by the email you register for this webinar. Okay. Okay. So last but not least, okay. So if you miss out this one, you can actually if you miss out the lucky voucher, never mind. You can actually follow us on our social media for more interesting content or promotion or even lucky draw like this. You can actually search for us on this our social media here. And then for our contact, you can actually contact us through here. So if you have any question, do actually email us and ask about anything. You can actually email us at to any branches from here. And this is our website and Facebook. So anything you can just let us know. So we will end our webinar for here today.